The foreign exchange market is one of the most influential markets in the world today. There are three major largest security markets in the world, and these are the New York Stock Exchange, the Nasdaq, and the Tokyo Stock Exchange. They have a daily trading volume of around 300 billion US dollars combined. The foreign exchange market, which we will talk about today, has a daily trading volume of around $6.6 trillion per a day. First and foremost, let's define the foreign exchange market. A market is generally a platform specifically made for the exchange of goods and services. So, the foreign exchange market here deals with the trading in currencies, and we will delve into details in this video. Well, we live in an increasingly globalized world. The world has now caught on the idea of comparative advantage. Businesses are more currently reliant on global supply chains to ensure products and services are produced and provided in the best countries as possible. For instance, if you want something manufactured cheaply, go to China. If you want something built to the highest standard quality, go to Germany. And when we talk about the best seafoods, they are from Japan. Previously, for the past century, this wasn't the way things seemed to be. You either produce something locally or it didn't basically exist at all. Intertrade was very minimal, and it was seen as an extreme luxury to have something like a foreign motor car or an imported food. If you ask Germany to produce iPhones, they would do it very easily. They have the infrastructure and technical expertise to produce these devices. But the problem here is they have a very expensive and a limited labor force. Also, they have a very stringent environmental protection regulations by their EPA, which component suppliers of these phones accessories can't reside out there. Same way China produces high-end luxury cars. But anyway, a German car would always remain German. Mercedes-Benz records China as one of its highest purchasers of its cars, irrespective of China has a similarly homemade cars out there in their country. And in fact, the Chinese generally testify to the German cars to theirs. China is more suited to mass medium quality manufacturing, like say producing iPhones. It has a much larger low-skilled labor force, and due to their looser environmental regulations, companies producing these phone accessories reside out there. So, instead of Germany trying to allocate some of its resources and labor force to build massively expensive phones, and China doing the same for cars, they can just agree to stick to what they do best. So Germany will make the cars and China will make the phones. And this is the current trend these days. This brings about comparative advantage to everyone. But the great distinction in reality is countries don't say bring 100 iPhone 11 Pros for one Mercedes C300. No. Manufacturers of these Chinese iPhones aren't get paid in euros. Neither German car manufacturers are paid in yuans. They use their own currencies. This such situation brings about a secondary market known as the foreign exchange market. The foreign exchange market is not just about changing your currency for a toy in another country or just some online shopping. It contains a whole lot. These type of simple retail transactions, though, make up just a tiny percentage of the total foreign exchange market. But you may ask, who are the real big players now? Companies, investment firms, and government all in combination promote global trade and liberation of currencies. These are those making the market more influential. Let's take businesses, for instance. If a company wants to open up a new branch in a new country, they are going to need to transfer money to that country and convert it into the local currency to run the business out there. So let's say an American fast food chain decides to set up a new store in New Zealand. If it sends over 40 million US dollars as an initial investment and transfers it into the New Zealand dollars, because of the current exchange rate, they would have received about 60,800,000 New Zealand dollars to run that business. So, if 3 years later, this franchise operation gets sold to a new investor for about maybe $68 million, this would represent a 70% return on investment for the American company. But at the same time, the New Zealand dollar has tumbled in value to a point where 103,360,000 New Zealand dollars is just worth 40 million in the American currency, which represents a true value of zero in investment. This is very dangerous. In this situation, the business has automatically collapsed due to foreign exchange risk, which is something that anybody planning on running an international business should be well aware of. For this situation, there is an existence of a third party known as the Forex market. This is an investor who is willing to take such risk. They undertake such activity through a financial instrument called derivative. Derivatives here involves the made-up things that has their true value derived from some other assets. What Forex investors do is basically make a bet with the foreign company. If the value of the foreign currency goes up relative to the currency in the home market, you, the foreign company, pays the investor. And if the foreign currency goes down, the investor pays you, the foreign company. So if the business agrees with the foreign exchange market, that means if either the foreign currency goes up or down, the franchise operation would always be at the safer mood and take the original money invested as 40 million US. That's 60,800,000 New Zealand dollars. Here, the business is in a safer mood. But if the franchise had not gone into such an agreement and the foreign exchange currency rises, the business would have taken as much as maybe 28% increment in profits in the dollar, and that's 103,360 New Zealand dollars for free. Moreover, government also forms a greater player in the foreign exchange market. Currently, the Chinese government, for instance, pumps a lot of money to decrease the value of their currency on the foreign exchange market. There is not enough time here to get into why they do this, but this is how they go about it today. The Chinese government basically use the Chinese currency to buy huge piles of foreign currency. This both pushes up the price of the currency being bought while simultaneously reducing the price of the currency being sold. This artificially devalues the Chinese currency, and the sole purpose of the government doing this is to just have a massive piles of foreign currency reserves in their coffers. These are some things which makes a lot of conspiracy theorists very scared.